G'day Kim, hope you're doing well. Thanks for the comment. So I had quite a lot of comments recently around building share portfolios and stock picking. So I thought I'd give you my views on this and see if I can point you in the right direction. Now, this is purely general advice. It doesn't take into account any of your personal information or situation. I highly advocate that you do get financial advice on this matter because it can be complicated and particularly when you're getting started, it does pay to get good advice on this because I've seen people get this very wrong. So I'll share with you my own philosophy. I personally don't stock pick. And the reason for this is because stock picking requires you to have a deep understanding on the underlying company, and you need to make essentially a call that you believe for whatever reason that particular company is going to outperform the index. The reason why we want to use an index or a benchmark is because ultimately this is the idea of stock picking. It is an actively managed strategy whereby you believe that you can perform above and beyond the market after fees and taxes. Now, let me flip the camera around and show you a little bit of an example of professional managers and their ability to outperform the market. Okay, so you can go to a website called if you just type into Google, the Spiva Report, okay? And what this will do is this will give you the ability to look at the active managers who have been able to successfully outperform the index after fees and taxes over various periods of time. So in this example, we're going to choose 15 years. So what we can see here is in Australia, 19.11% of all funds in Australia outperformed the S&P 200, which is the top 200 companies in Australia, which means nearly 81% of actively managed funds underperformed the market after fees and taxes. This is pretty scary, right? And these are professional managers who do this for a living. Now let's have a quick look in the United States. Over a 15-year period of time, less than 8% of funds outperformed the market after fees and taxes. So 92.19% underperformed the S&P 500 after fees and taxes. Now the reason why I show you this is that if professional managers who do this for a living, who manage hundreds of millions and potentially billions of dollars in assets under management, with all of their research teams doing this all day, every day, can't outperform the market the majority of the time, what makes you think that you can? So this is the reason why I personally invest in index funds. And an index fund is basically going to invest in an entire market or a benchmark. Let me show you another diagram. So this diagram explains it pretty well. So let's assume that in this case, there was 10 of the biggest companies in the US, and you bought an index fund that was for those 10 companies. You would own all 10 of the companies proportionate to their size. So you'd own the biggest chunk of the biggest company, and you'd own the smallest chunk of the smallest company. Now, if we're talking about Australian shares here, let's say the ASX 200, potentially the ASX 300. That's the top 300 companies in Australia. And if you went and bought that index fund, you would own all of those 300 companies, with the biggest slice of the largest company and a little slither of the 300th company. The benefit of this is that you get the average of however those 300 companies perform over time. Some of them are going to do really well, some of them are going to do pretty crap, some of them are going to do average. And what will sometimes happen is some will fall out of the 300, but they're replaced with new ones. So what it means is that you are betting on the entire market as opposed to an individual company. Now, there was an interesting statistic that I saw is that between 1970, I believe it was, and current age, if you look at the S&P 500, which is the top 500 companies in the US, over 70% of those companies went bankrupt. So there's a significant chance that those companies delist from the stock market over a long period of time, and you may find yourself in a position holding a company with a lot of exposure, a lot of eggs in one bucket that could ultimately impact your overall wealth creation. So my personal view is to use index funds and ETFs. And if you are going to use actively managed funds in order to invest your money, you want to make sure that you do your research to find actively managed funds that have had consistent long-term performance and ultimately going to contribute value to your portfolio. As part of our overall philosophy, we help our clients build these portfolios. So let me show you the strategy that we use for our clients. So we've created a pretty lengthy document that's called our investment philosophy, and I'll kind of run you through what this looks like. Now, essentially, the whole idea of the advice process, and we've been able to work out that 89% of returns are actually produced through asset allocation. So the overall investments that you choose, not the underlying companies or market timing, right? Now, our entire process in terms of the value that we add to our clients is that the advice we give is 80% of the situation. Investments is 20%, and then we split that basically focus of 10% on asset allocation and then 10% on the actual selection of the investments and getting the timing right. Now, our approach is pretty simple. We focus on getting our clients to increase their active income so they have more surplus in order to invest. We then help them build a property portfolio using smart leverage and buying really good quality properties that perform over time. And then we build a satellite portfolio of liquid investment, which includes index funds. For some of our clients, we do set up direct equity portfolios, potentially some hedge funds or active funds. And the idea is that we want to try and fill these three buckets. We want to be able to make sure that we've got short-term savings, we've got income-based investments, and we've got growth investments for the long term. Now, when it comes to understanding this, the biggest factor when it comes to building wealth is about understanding your risk profile and the relationship between risk versus return. In other words, how much money do we put towards growth assets like shares and property, and how much money do we put towards defensive assets like bonds and cash? So, I know this seems like a relatively simple question of what stocks to pick. What is more important is getting your investment strategy right and making sure that it is right for you. Tactics or stock picking represents a very small part of the overall investment journey. And by understanding how to financially plan and create your own investment philosophy and then sticking to that investment philosophy over time is what's going to drive the results. So if you're interested in finding out more, my first book is called Enjoy the Journey, Creating Wealth and Living the Life That You Desire. It gives you an end-to-end framework of how you can implement this yourself. Or if you'd like to have a conversation around how we can help, feel free to reach out, and love to support where I can. Hope this has been helpful. Catch you soon.